If you go to archive.org, you'll find a history of what websites used to look like throughout time, which is super fascinating for anyone who's ever wanted to see what news publishers were putting out before, during, or after market crashes. Or, of course, if you just wanted to relive some childhood memories. I was using this website to dive deep into some Warren Buffett lore when I discovered this really fascinating quote. Warren Buffett said, "I have no idea what my rate of return is, but knowing for myself how hard it is to do the calculations right, I'm suspicious of anybody's numbers." That concept is so hard for the public to grasp, and I think it's because we're so attuned to watching people quote the rates of returns on apps and comparing actually incompatible returns. I'm convinced that generally people are really good at math. It's just where we run into troubles is the application of the math. So that's why, even though we love talking about investing in finance, we've created this stock portfolio journey to teach people how to calculate and communicate their performances. And in this video, we're going to be talking about how to adjust for taxes. Now, as you can imagine, I've seen so many portfolio updates that if I had a penny for each one I watched, I might finally be able to purchase that Class A share of Berkshire Hathaway I've always wanted. And after seeing so many of these portfolio updates, I can tell you that one of the most common issues I see across all these updates is that there's a need to calculate an after-tax return. Most people don't do that. One person I like to look up to for who does it right is Warren Buffett, who every year during his annual letter to the shareholders provides his after-tax return and compares it to the pre-tax return of the market. He and I both believe that if you're going to outperform the index, you best outperform after considering taxes. Otherwise, what's the point, right? Although, in a future video, I'll be covering some performance errors in the Buffett Partnership Letter, so show us some hype for that. One way to illustrate the importance of using an after-tax return is pretend you had two investors that said they made a 10% pre-tax return. Well, what if in the first investor's case, the entire gains were made with dividends? It's going to be taxed at the ordinary income tax rate. And then you had the second investor, all 10% was made by price appreciation for stocks held longer than a year. They're going to be taxed at the long-term capital gains rate, which is far more tax efficient than the ordinary income tax bracket. Meaning, even though both of them presented to you 10% returns, the second investor actually outperformed after-tax considerations. The only way that we can assume that someone outperformed if you don't have the tax bracket information is to put them in the highest tax bracket. And if they still outperform with that, then you can probably definitively say that they outperform. And I'm sure that makes sense to all of us. But the tricky part is actually how do we adjust for our performance? So I'm going to show you that now, and hopefully it won't get too boring, and we can have Scott spice it up a little bit by showing you funny gifs or something.
Linked in the description is the spreadsheet we use to help calculate and communicate our performances, and I'm going to walk you through where we account for taxes as a general outline before getting into the nitty-gritty. And the first place we do that, ironically, is actually this pre-tax return tab, and it's this red line item in our transaction history, that $9.32. This adjustment is for when we have to actually pay the government for the taxes we incurred in the prior year. And again, that doesn't have to make sense now, I'll explain it in a second. But the next place, more fittingly, that we adjust for taxes is the taxes tab. So this first section here labeled taxes is a total of all the gains we made taken from the cost basis sheet and separating them based on whether they're unrealized or realized gains, and then further separating them based on how they're taxed. Beneath that is the personal tax effects section, which takes the totals from above and gives you how it affects me in my personal situation given my tax bracket information. Really, the number we're concerned with is at the bottom, the $501.63 that I would have to pay the government today if I sold everything and had to pay them today. So I take the $500 and subtract it from the pre-tax adjusted ending balance of $10,300. And when it says adjusted, it just means I'm excluding any free stocks that I made to get the after-tax adjusted ending balance of $9,844.52. So that's all the places we account for taxes, and now I can explain why we do what we do. So let's pretend on day 0, you put $100 into an investment platform. Then 6 months later, your portfolio value is $110. But let's say it was a wild, wild ride to get there. It made you not be able to sleep at night, and you wanted to sell all. That means you have a $10 realized gain, and then reinvest it into something that was, letting you sleep at night. So reinvesting all $110, but in a different stock. And let's say 12 months later, this isn't drawn to scale, 12 months later, it did exactly what you wanted it to do. It went up a little bit more steadily, but it still gave you an ending portfolio value of $120. So it still did really well. So how do I calculate pre-tax and after-tax returns, pre-tax and after-tax balances? I'll explain it now. So at the 0-day mark, it's pretty simple. We had 0% pre-tax and after-tax. There's no difference. It's when we get to the 6-month mark where there's an adjustment that has to be made. Well, the first thing I do, if you remember from the Excel sheet on the taxes tab, at the very top, I say I had a portfolio value of $110, but I also have $10 in realized gains. So that way people, if they want to put their tax brackets, they can put it in there too. So that's one way. Another way that I'd want to say is pretend I'm in a 10% tax bracket, just for easy math. Well, 10% of the $10 we owe to the government equals a $1 liability that we have to pay to the government at some point. It is realized and we will have to pay it. So if I were giving somebody my ending balance here, I would say we have $110 in portfolio value, but we owe $1 in the future, which means our after-tax adjusted balance is $109. So if I were giving somebody my pre-tax and after-tax return at the 6-month mark, I would say my pre-tax return is 10%, and I'll put it in a rainbow color, because we went from $100 to $110 without considering taxes, but the after-tax return is 9%, because we went from $100 to $109. And this is how I calculate the pre-tax and after-tax returns of the 6-month time period. But I have something I want to share with you.
Now let me explain to you why I'm wrong to do this, but it's wrong in a good way. Well, essentially, we owe $1 to the government using the previous example, but we don't actually have to pay it until the government actually takes money out of the account. That's because there's a float or period of time where we get to keep that dollar and reinvest it. So by me saying that I have to pay it right away, it's going to have an adverse effect on my return, meaning it'll decrease it. This will make a more conservative return. And as value investors like to say, we'll have a large margin of safety. So if we want to say we outperform, we have to outperform even considering these factors. So that way we can be more definitive in our claim. And I hope that makes more sense. If not, we're going to get into the details and you'll see more of the full picture, and I hope it'll make sense then. So let's get back in.
Okay, using our example from last time, we're going to look at how to calculate and communicate the performances at the 12-month mark. So the first thing I'm going to do is just provide all the information for people. So I'm going to tell people I have a $120 balance, I have $10 in realized gains, and I have $10 in unrealized gains. And that $10 of unrealized gains came from when we went from 110 to 120, and we haven't sold yet, so it's going to stay unrealized. Assuming we're still in this 10% tax bracket that I'm using for easy math, we're going to need $1 for the realized gain and $1 for the unrealized gain. So if I were going to show people my returns and give them an after-tax ending balance, I would take the $120 that we have as portfolio value minus $2 in liability, and I would tell people my after-tax ending balance is $118. Meaning that if I were going to show somebody my pre-tax return, I took $100 and made it into $120, so that's a 20% pre-tax return. And if I wanted to show people my after-tax return, I would say, using a different color here, we'll use green, I took my $100 and turned it into $118 after tax for an 18% after-tax return. So that's what I would do. I'd give them the 20%, the 18%, and the information it took to get there, and the transaction history. And that's how I communicate the performances in the 12-month period.
And some of you might be wondering how we adjust for losses in the account, and it's the exact same principle as gains, except instead of subtracting account value, we're going to add it back so long as it makes sense within the limitations of the IRS code. For example, there's caps to how much loss you can carry over to the gain and how much loss you can carry over into future years that we must consider. So everything we've covered in the whiteboard so far has been to show you how we got to the adjusted after-tax ending balance that I showed you in the Excel sheet. But there's another tax consideration we have to go over, and it's that red line item in the transaction history. That is the moment where the government takes the money out of our account for all the taxes we had incurred in the prior year. So how do we adjust for that? Well, I've seen so many portfolio updates, And one of the ways I've seen that's kind of common, kind of not common, is people will sell stocks out of their account. So if they owe like $20 to the government, they'll sell $20 worth of stocks and then pay the government that way. But as you can imagine, it's very tax inefficient because you create more of a tax burden that way. What you'll see most people do is they'll have a separate account on the side, like a savings account, and where they owe $20, they just take it out of the savings account. The problem with that is if you don't get the full asset allocation, you never get to see the adverse effect on your return. So there must be a way for us to account for the external account without having to sell our stocks. And that's what I'm about to show you right now.
Before we begin, I just want to reiterate that if someone provides the full asset allocation, we don't have to do anything crazy. It's only when people don't that we have to make some kind of adjustment. Now, I also need to mention that I think it would be unreasonable to suggest people provide it because it comes with a huge amount of transparency. So more often than not, we have to do some kind of transaction or adjustment to make sure we're accounting for when we pay the government on the taxes we owe. So using the same example as before, let's pretend that there's a day in the future where taxes need to be paid. Money's going to leave our account. And let's also pretend that our stock account traded at the same level, so we still have $120 in stock value, 10 of which is realized, 10 of which is unrealized, meaning that we owe $1 to the government now, and we'll owe $1 to the government in some time in the future with a 10% tax bracket. So what you'll see some people do is if they have $120 in stocks, they'll sell $1, pay it to the government, but then that'll create, if they're in a 10% tax bracket, a liability of 10 cents that they owe in the future. But that's not tax efficient. We don't want to do that. What you'll see other people do is they'll have an account on the side that has $1 in it already. That's probably making like, I don't know, savings account interest level performance. And then you have your account right here that's making $120. And then they'll pay it out from that account, but you never see it affect this portfolio. We want to find a way to merge the two. And that's what I'm about to show you. So let me just erase this real quick. Let's pretend our portfolio value on an after-tax adjusted basis is $118. And the way we got that is we just have $120 in stocks from up top. We owe $2 in liability, which is from here. And our after-tax adjusted balance is $118. This is before we pay taxes. Now on the day taxes are paid, money's leaving our account, we have to subtract, we have to subtract $1 in value. So now we're going to have $119 in value. We're going to get rid of that $1 in liability that we owe. And our after-tax adjusted balance is $118. How do we do this in our spreadsheet without actually sacrificing $1? Well, what we're going to do is essentially just take one small piece of this pie and trade $1 of profit and convert it into $1 of contribution. This will create an adverse effect on our overall return that we would expect when we pay out money. It would kind of be like saying, and if I can just erase all this real quick, it would be like saying if we had a portfolio with 118 after-tax value that we subtracted $1, so minus $1, and then we immediately put in $1 exactly the way it was before. So this value doesn't change at all, but we're just trading $1 as a profit for contribution. So to reflect this, all you have to do, the bottom line, and I know this is pretty complicated, I haven't found a more simple way to explain it yet, I'm sorry, but all you have to do, all this boils down to, is you have to add the tax liability as a contribution. I don't want to spell out the whole word, I guess I am though. So if you go to our Excel sheet and you look at this red line item, that's exactly what we do. We owed $9.32 to the government, so we're going to add it as if it were a contribution. And that will decrease our return exactly the way we'd expect, and it's exactly as if we left $1 out of the account to pay the government and then put $1 in so everything remained the same. That is how you adjust without asset allocation, without having the burden of selling $1 in stock and then having a tax liability of 10%, making 10 cents to the government that you owe. Without having to do that, all you got to do, add the tax as a contribution. That's it.
And if you made it to the end of the video and your head is reeling in circles, then don't worry about it, you're human. None of this should make sense to anybody without giving a lot of time into it. The one thing I just want people to take away is if they're looking at portfolio updates or providing it, then an after-tax return should be provided. Otherwise, how do we know if you actually outperformed a benchmark or anything? And if you want to provide this to your audience and all of this is confusing, then the one thing I'd recommend is just provide your transaction history, and eventually you'll get some nerd, I don't know who, but some nerd will go and look at it and do the math for you. So transaction history is number one. The last thing I want to conclude on is just if you could please go down to the bottom of the video and find the subscriber count, and just make sure it's not a number that you wouldn't leave your TV volume on. So if it's like on a 527, we don't want that. Let's get it to 528 or 530, some round nice number. Wait a minute, people don't put their volume at 527? You know what I mean though. So thanks for watching, and until next time.